Hey, did you see oil was back up again this week? That makes 2 weeks in a row. There's definitely more confidence in the market now that some of the tariff situation's been tamped down a little bit, at least for the next 90 days with regards to China. But that puts oil in a really interesting price for US producers. We're going to dig into some of that data this week in oil. Hey, I'm Aaron Keldo of the Oil Balance, and I'm here to elevate your understanding of the oil markets. So let's get into it today. All right. There's a couple of things I want to address from the comments. And again, thank you very much for your comments. They're very appreciated. One of them is that the OPEC increases are just to legitimize cheating. That's absolutely right. That's what's going on. They can no longer control places like Kazakhstan and Iraq. And as I mentioned time and time again, that's how these deals break apart. When people figure out, and individual countries figure out that they can just sort of produce whatever they want. So that's where we're in a really sensitive time. And we need to see how Saudi plays this because Saudi's usually the biggest loser in these things in terms of to get back dominance, they have to just come out and increase production and flood the market. That's what they've done in the past anyway. Let's leave that issue for the next couple of weeks, especially as we go into the OPEC meeting on June 1st. We'll get a little bit more data about what is happening in the month of May over the next couple of weeks as well. So let's just hold that to the side for right now. There's two other things I want to get into, though, this week. One is the rig count, and we'll definitely be talking about that. And the second one is permits. So let's go ahead and jump in right now to the chart pack here. So as you can see, as I mentioned in the intro, oil prices are up for the second week in a row. We've got it to almost $64 here earlier this week and then came back down with some of the Iranian headlines going around. If you hadn't seen them, it looks like the US and Iran are having at least somewhat productive talks. The market's worried that that would let a lot of Iranian barrels come back onto the market very quickly. Keep in mind, there's somewhere between 20 and 40 million barrels of oil, of Iranian oil, on floating storage. So it's already on the vessel, sitting in, well, they can be in different places. Some of it's sitting right in the Persian Gulf, some of it's parked offshore in greater Asia. But that, if there was some sort of agreement to happen, those barrels could come into the market very quickly. Like I said, they're already on the vessel. It's just a matter of getting it to wherever that needs to be offloaded. So the market did come back down a little bit off of that. There's been some instability in Libya. As you might have seen, there was sounds like a hit taken out. For right now, it looks like production is doing okay despite all the chaos happening in Tripoli, but I think it's really worth keeping an eye on. So that's another, million to million two barrels per day of capacity that in theory could be taken offline, and in the past for political reasons has definitely been taken offline. So we definitely need to keep an eye on that. But that leaves us sort of at the high end of the range that we discussed previously. As you can see, these two lines I have outlined here, the lows from the past couple of weeks, I think the last 27 trading days, we've tested this low level support line right around $55 and bounced off at this. So there's only been 2 days where we actually either hit or came close to bouncing off the support line. These weekly charts make it maybe look a little bit more dramatic than it was, but really it's only 2 days that we tested those. And of course, this week we have much higher lows, which is a good sign for the bulls. That's what you want to see. But for the time being, we're at least stuck right at our resistance level for now. We have another sort of horizontal resistance level up here closer to $66, a little bit above. Of course, we'd have to get through this sloping resistance line to make that happen as well. That could be possible, especially given this week's actions. And, with headlines, it'd probably be pretty easy to push that above there if we needed to. At any rate, this low $60 value for WTI does put shale in an interesting point. And we've been talking about this for the past couple of weeks. Diamondback, I think, put it very well that they're taking their foot off the gas. They're waiting to see what happens. They're not putting their foot on the brake. They're not putting their foot on the gas. They're just taking it off and kind of waiting to see what happens. On the gasoline side of things, we are seeing really good demand, at least in terms of total demand. So what I'm doing is I'm taking domestic plus exports, putting in a 4-week average to smooth that out a little bit because these numbers can be quite choppy. But as you can see, we're not too far off of 2023 levels, sort of the high end of the 5-year range here, doing a little bit better than year ago as well. We should be continuing to see this trend upwards, just the seasonality of things. We're going into sort of maximum demand season as driving season really takes off. So we should see demand continue to accelerate, if you will, through June into July, and then we'll see what happens after that. Sometimes it does start to come off for various reasons. So uh, at any rate, for the next 6 weeks or so, we should see demand continue to increase, which would probably be pretty good news for refiners. In terms of the margins, again, this is what sort of a view of what the refiners are looking at. In the Gulf Coast, we're still seeing the gasoline crack perform pretty well. In New York Harbor, not as well. We'll see in a minute where inventories are doing. Specifically in New York Harbor, they're adequate, let's say, where gasoline inventories are much tighter in other places like the Gulf Coast. If you look at the diesel side of things, ULSD, ultra low sulfur diesel, we're just kind of humming along a little bit better than a year ago. Nothing fantastic, nothing like 2022, but hey, it's still pretty good numbers. In terms of the actual NYMEX delivery zone, so remember most of the NYMEX futures contracts are physical delivery. So I think it's worth taking a look at. As I mentioned, Pad 1B, which would be New York Harbor gasoline inventories, had a pretty big drop this week. They've fallen to year-ago type levels after being, sort of middle of the range for most of April and May. This was a pretty big drop this week, and we are having refinery activity pick up. I'm wondering if maybe next week's inventory number maybe bounces a little bit higher, if this was some sort of mistake or someone forgot to report or something. It seems a little bit odd to have such a big drop, but it's nothing terrible right now. Distillate stocks, Pad 1B, again, that's New York Harbor distillate, are quite low. We're not quite below the bottom of the 5-year range. We are definitely below year-ago levels, so still tight on distillate. Of course, Cushing crude inventories are low. They've been below the 5-year range here for the past 3 weeks. I think this is still a concern, especially as we go into the summer months. That's when those Cushing spreads really like to blow out. So maybe that's something else to keep in mind in terms of potential upside for crude, sort of regardless of what OPEC or anyone else does. And then propane, we're not building quite as fast as we did last year. We had a longer drawdown period than we did last year. Still a little bit concerning if you look at NGL stocks outside of propane, so everything else but propane, they're actually above the 5-year range, which is sort of interesting. So still seems sort of firm, especially on the crude and distillate side on NYMEX related inventories. Gasoline, like I said, we're kind of back to year-ago levels. My hunch is that inventories bounce up next week, but we'll see how that goes. In terms of West Coast prices at the pump, these are wholesale prices. LA definitely been taking off here the last couple of days, and then diesel got an uptick. Why this is important, especially on the diesel side, is we're looking for any signs of a drop in demand from the ports, and I do have port information coming up later in the presentation here for you. Inventories are really low for both gasoline and diesel, so I'm not too surprised that we get an uptick in prices. I'm not really seeing anything just yet that would tell me that demand is terrible on the West Coast. Demand seems to be humming along okay, and again, we'll look at the ship data coming in here in just a minute. So let's switch over to shale real quick, and I want to sort of address two issues, or just sort of let you know what's going on, and you can come to your own conclusions. The first one is if you put WTI prices in terms of, in this case, I chose 1985. It was originally for a different purpose, but I think it fits. It suits this conversation pretty well. If you take WTI prices and you put them in $1985, so there's been a ton of inflation. the dollar is worth about 1/3 of what it was the dollar in 2025 is worth about 1/3 of what it was in 1985. That's how much inflation's gone up since then. It kind of puts a different spin on how efficient that U.S. shale has really become. You can see we put in a low in domestic crude production right at 5,000 or 5 million barrels per day in 2008, and it's been sort of an uphill slog since then. Back in the 2007 2008 time period, in terms of nominal dollars, we were averaging $100. It should $99 per barrel in 2008. So prices were quite elevated. So it makes sense that we got a production response. What I want to point out, though, is more since shale really started taking off and we started to be able to export in the 2015 2018 sort of range. Prices historically, if you again taking them back to like a 1985 type number, have been relatively low. So we've been stuck again in terms, between sort of mid 30s and high teens during that time period. Yet production still continues to grow. So my point is not really 1985 dollars in 2025. The point is that production has been able to increase during this time when historically the value of the dollar, doesn't go quite as far, right? So that's really a testament to the U.S. shale production that, they've been able to squeeze those barrels out of the ground when objectively the margins, are squeezing right back on them. The other thing I want to point out is in terms of rig counts, just the incredible efficiencies that have been going on. So the way that the drilling works these days, they're coming up with all sorts of innovations. They're able to put in much longer laterals. You see some of the literature where they're actually doing like a U-turn sort of lateral, so they go out a certain distance and then bring it back. So it takes fewer rigs to get the same amount of oil out of the ground. So one of the comments that I got was rig counts have been down. They've been down 5% over the past year. And yes, that's true. But we've also seen production continue to climb during that time. So what I did on this chart is I just took the tight oil production, that's what the IEA calls shale, the tight oil production number, and then filtered through the Baker Hughes rig count just to give me directional rigs, so we could see more of a shale type investment, if you will, on what's actually going on. So the point being that even as these rig counts, you've seen them come down from sort of 2023 when prices got quite high in 2022. Obviously, rig counts went up and then started dropping off as we got into 2024, and then dropping off a little bit more in the second half of 2024, and have been sort of flat since the fall of 24. We have been seeing them drop off a little bit. Rig counts for oil was down 1 this week, so not a huge drop off, but we have seen a drop off since sort of middle of 2024. Yet production keeps on moving higher. Now, I've talked a couple times about the latency. So in other words, it takes 3 to 6 months once these guys punch a hole in the ground for that oil to actually come to market. So there is a little bit of that going on, and I've not adjusted that in this chart. This is, sort of week for week, everything's lined up in that perspective. So just again, want to point out, yes, rig counts are going down. That's maybe not the best indicator of what production will do. If we have a huge drop in rig counts, then yes, you will get sort of the requisite drop in production. I don't know that anyone's calling for that right now. It seems like the guidance that we got from the handful of shale producers that have put out their earnings, we're talking about 15 to 20 rigs going down over the course of the next year. Again, that's a relatively small sample size, and we'll see what they do. Again, they were looking at a situation, where it seemed much likely we'd stay in the mid 50s than the low 60s. And that does make a difference in terms of what they're going to do. I did see some articles as well talking about, especially in Texas, the drilling permits going on in May, they're really low. If you look at that May number, it's just through May 8th so far, at least at the time of this recording. And yes, it is low. The number of permits approved from May 1st to May 8th is very low compared to what was approved for the entire month of May in 2024. So that's probably not a fair comparison. What's probably a better comparison is if we look at sort of the full months that we do have data for, and you can see that for every month except for February, we did have more permits approved. Again, this is a little bit ambiguous because this would include permits. This is all permits, right? So it could include permits for companies going just after natural gas, for companies focusing on wet gas or the NGLs side of things and not necessarily oil. So again, it's not, unless you see a huge drop in approved permits going forward from May, which again, it's going to take us several weeks before we get that information coming in. But if we would see them drop for the full month, then maybe you start getting more confidence, that production is really going to fall quickly. So again, by the time we get that information, we will have already had the next OPEC meeting, which is June 1st, and that's probably a bigger market mover anyway. And then the last thing I want to say about Texas Railroad Commission, is sometimes they go back and revise their data. The most recent data point from Texas Railroad Commission is, let's say, subject to change. Maybe not the most reliable data point, so keep that in mind as well. All right, so moving on to the shipping data that we had this week. This top bar is the information we had last week. This lower bar here is the information that we have, is the most recent information from this week. So a couple interesting things standing out. If you look sort of, the data over the past couple weeks, it looks like May, with, using these bottom numbers as sort of a forecast, if you will, that puts us at just over 400,000 TEUs for the month. If you go back and look at the same time period, so I want to say that's week 18 through 22. If you look at that time period in 2024, we did 463,000 TEU. So we are coming up short of a year ago from that perspective. This number for the very end of the month is maybe a little bit suspect. Maybe that gets revised higher. We are getting a very good number for next week, for week 21. So that's sort of a good sign. We'll see if that continues, if that actually proves itself out. So you can see that these forecasts we had for the past 2 weeks are actually doing pretty well. Last week for week 20, they were projecting, call it 87,000 TEU equivalent. For now that we have a little bit better data, a little bit better insight to this past week, we're down a little bit to 85,000 TEU. So again, it's a pretty good forecast, I would say. So we'll see how these things work out, especially for week 21, and we'll keep a close eye here on week 22. Now, looking at retail prices, I added this table here because you can get some volatility, of course, depending on what part of the country you're in. Overall, gasoline prices continued to decline. They were down just over almost 2.5 cents. Diesel prices were down not quite as much, but again, they're going down. So it looks like PADD 4, Rocky Mountain and West Coast, you still had price increases, and we sort of saw that previously. These are gasoline prices here. We saw that previously with the wholesale prices in California going up, and that was definitely reflected in the retail value as well. I will say, though, that we are getting closer to 2019 type values than we are to a year ago. The other interesting thing is, as I mentioned before, seasonally, gasoline prices should be going up this time of year, but we're kind of getting to that inflection point where, unless you have some sort of big refinery outage or some spike in demand or something weird like that, that prices usually tend to start trending downward like they did last year. Sort of once we get into June, all the expectation, all the hype around the anticipation of driving season sort of wears off, and prices sort of start to grind lower from there. So that could be another good sign too for the U.S. driver if things continue to move lower there. But again, got a pretty big drop in lower Atlantic, so that would include Florida and Georgia. Gulf Coast was down 3 cents, Midwest down almost 5 cents, so a pretty big drop there as well. So here's a summary I put in here. Hopefully that helps you guys. And remember, please go to the oil balance for more information. There's a couple things I didn't even talk about this week that we put in the Elevate report. If you want to go there and sign up, that's a great subscription. If you want to get a little bit more information than we're able to share here on YouTube, again, I highly recommend that for you. But thanks for watching. Thanks for your comments. Remember to subscribe to this YouTube channel and like this video. Thank you very much, and we'll talk to you later. Bye.